All right. Welcome back to the deep dive. And today we're diving headfirst into a topic that can, really get the heart racing for a lot of people, I think.
Yeah.
Market volatility.
Absolutely.
It's one of those things that I think, a lot of investors, they hear that word and just want to run for the hills.
Run for the hills, right?
Right. But the thing is, and what we're talking about today, is you don't have to just run for the hills. You can actually potentially, maybe, profit from it.
Yeah, for sure. And I think that's the really interesting thing about, market volatility.
Right.
It's not just doom and gloom. There's actually opportunity there.
Yeah, and that's kind of the exciting thing about it, right? I mean, it's exciting and terrifying, I think, all at the same time.
Yeah.
But that's what we're talking about today is hedging.
Exactly.
And hedging is basically, protecting your investments when the market takes a downturn. And we're going to be looking at two key tools to do that today.
Right.
One is the VIX, and sometimes they call that the fear gauge.
Yeah, exactly.
Yeah. And the other one are inverse ETFs. And these are really kind of cool tools.
Yeah.
Because they kind of act like, financial opposite day.
Right.
Where you can actually profit when things are going down.
Exactly.
So let's start with the VIX, right?
Yeah.
This is like a thermometer for market anxiety.
Yeah, absolutely. So the VIX, or the volatility index, it basically tracks, like you said, like a thermometer. It tracks the expected volatility of the S&P 500 index over the next 30 days.
Okay.
So what that means is it's calculated using, some complicated stuff, using options contracts in the S&P 500, but essentially the higher that expected volatility, the higher that VIX number climbs, the hotter that thermometer gets.
Okay, so let me just jump in here.
Sure.
I mean, does that mean, so if the VIX is high, does that automatically mean that the market's going to crash?
That's a great question. And that's kind of a common misconception about the VIX. People see it spiking and they're like, oh no, the sky is falling.
Right.
But it's not necessarily like that. Because remember, what it's measuring is expected volatility, right? So it's not necessarily saying the market's going to crash. It's saying that investors think there could be some big swings coming up.
Okay.
Whether those are up or down.
Got it.
But you're right. Historically, when the VIX spikes, that tends to happen when there's a lot of fear and uncertainty in the market.
Yeah. Okay. I mean, that makes sense, right? If people are scared, they're like, oh, it could go way up or way down.
Exactly.
Okay. So how can investors then use the VIX to their advantage? How can they actually make money off of this?
Yeah. So there's a few ways you can, kind of play the VIX.
Okay.
So one is you can actually directly trade VIX futures and options contracts.
Okay.
So that's if you really, want to get into the nitty-gritty and kind of speculate on where the VIX itself is going.
Okay.
But then there are also, a little bit more accessible ways to play it, which are exchange-traded products or ETPs. And some examples of those are, VXX and UVXY. And so those are kind of like ETF that track the VIX.
Okay.
So, if the VIX goes up, these will generally go up.
Got it.
But there is a key difference between the two.
Okay.
So VXX, it just aims to replicate the daily moves of the VIX.
Okay.
So if the VIX goes up 1%, VXX should also go up roughly 1%.
Got it.
UVXY, on the other hand, is a leveraged product.
Okay.
Which means it tries to magnify those moves.
Okay.
And it typically tries to double the daily move of the VIX. So if the VIX goes up 1%, UVXY is trying to go up 2%.
Right.
So you can see...
It's riskier.
It is much riskier, exactly.
Yeah. Okay, so if you think things are going to go, haywire.
Yeah, if you're really,
Why is your play?
Yeah, if you're really bearish, you're thinking the market's going to take a tumble. UVXY could be a way to potentially, profit from that. But it's very risky. Whereas VXX, if you're just looking for maybe a little bit of a hedge, a little bit less volatility,
right,
that might be a better option. But yeah, it really depends on your, your own risk tolerance and your own market outlook.
Right. I mean, I guess just like any other investment, right?
Exactly.
Okay, so let's move on to inverse ETFs.
Yeah.
You were calling them the opposite day of investing.
Yeah.
I love that because I think it really kind of helps paint this picture, So tell me, how do these things work?
Yeah, so basically imagine you have, a regular ETF that tracks the S&P 500, right? When the S&P 500 goes up, that ETF's value goes up.
Right.
Well, an inverse ETF is designed to do the opposite.
Okay.
So when the S&P 500 goes down, the inverse ETF's value is designed to go up.
Interesting.
So they're literally designed to profit when the market declines.
Okay, so if I'm sitting here and I think that the market, I've been reading all the financial news. I'm like, oh man, I think we're headed for a correction.
Right.
I could buy some inverse ETFs.
Yeah.
And that could offset the losses in my other investments.
Exactly. It's a way to hedge your portfolio.
Okay. Okay, and are there different types of inverse ETFs?
Yes, there are. So
You mentioned a couple earlier, right?
yeah, it did, yeah.
Like what were those?
So some inverse ETFs are very straightforward.
Okay.
They just track the underlying index with a one-to-one inverse ratio.
Okay.
So a good example of that is SH. That's a non-leveraged inverse ETF that tracks the S&P 500.
Okay.
So if the S&P 500 falls by 1%, SH should, in theory, rise by 1%.
Okay.
But then there are also, getting back to that idea of, maybe playing with fire a little bit, there are leveraged inverse ETFs.
Okay.
And those aim to amplify the inverse returns. So they try to, really juice those returns.
What?
So one example of that is SPXS. That one's designed to deliver 3 times the inverse daily performance of the S&P 500.
Right.
So if the S&P 500 drops 1%, SPXS is aiming to gain 3%.
Wow.
And then another one that's similar is XQQQ, and that one tracks the NASDAQ Q100, but it also has that 3 times leverage.
Okay, so yeah, I mean, like I said before, these sound tempting, but it also sounds like you could really lose your shirt.
Yeah, absolutely. And that's why I say, kind of playing with fire.
Right.
Because that leverage, it's a double-edged sword, right?
Right.
So if the market moves against you, you can lose a lot of money very quickly.
Okay.
And it's important to remember that, these leverage products are really designed for short-term trading,
Right.
not long-term investing.
Okay. Yeah. I'm starting to see why this whole hedging thing can be so complex.
It is. It's definitely not, set it and forget it.
Right.
You have to really understand what you're doing.
Yeah. Yeah. And I guess that's why we have you on the show.
Well, I try to help.
Right. Right. So, I mean, and so it's not just what they are, but it's also when to use them right and how to use them.
Exactly. And I think one important thing to point out with these inverse ETFs
Yeah.
is that, they can be really valuable during a market correction.
Right.
But if you hold them for too long in a bull market, when the market's going up, their value can actually erode over time.
Oh, really?
Yeah, and this is because of something called decay.
Decay. What is that?
Yeah, so basically the way these leveraged ETFs work is they reset their leverage every day.
Okay.
So what that means is that if the market is moving sideways, or even worse, if it's moving against you, like if you're in an inverse ETF and the market's going up,
Right.
that compounding of the daily resets can actually eat away at your investment.
Oh, wow.
Even if, maybe eventually the market does turn around and go the way you thought it was going to, you could have already lost a lot of money just from that decay.
So it's not as simple as just saying like, oh, I think the market's going down, I'm going to buy this, and then wait for it to, make me a bunch of money.
No, it's definitely not that simple.
There's more to it.
There's a lot more to it.
Yeah. Okay. So for our listeners out there who, maybe they're interested in this, they're starting to think about, how could they incorporate some of these hedging strategies into their portfolio? What's like the biggest takeaway? What's the one thing that you really want them to remember?
I think the biggest thing is to approach hedging strategically, not emotionally.
Okay.
So, don't let fear drive your decisions.
Right.
If the market's crashing and you're panicking and you're like, oh my God, I need to buy all these inverse ETFs, that's probably not the best time to be making decisions.
Right.
So really take your time, do your research, understand the risks involved,
Yeah.
and then figure out how these tools can fit into your overall investment goals and your risk tolerance.
Right. I mean, it makes sense, right? You don't want to just jump in
Exactly.
without really knowing what you're doing.
Yeah, because, hedging can be a really powerful way to protect your portfolio during those turbulent times.
Right.
But it's not a guaranteed path to riches. It's just a way to potentially mitigate some of those losses.
Right. Right. Well, I think that's a great point to end on. And to our listeners out there, as you continue to explore the world of market volatility and hedging,
Yeah.
I want you to just think about this. How could you apply these concepts, right, to your own investment approach?
Yeah.
Maybe it means adjusting your portfolio allocation.
Right.
Or maybe it just means thinking about those market fluctuations a little bit differently.
Exactly.
But remember, knowledge is power. And the more you understand about how the market works and the forces that drive it, the better equipped you're going to be to navigate all of its crazy twists and turns.
Couldn't agree more.
Thanks for joining us on The Deep Dive.
Absolutely. Thanks for having me.
We'll see you next time.
See you later.